Okay, Candle Range Theory Trader back with the last deep study that we will be doing on this channel, the 915 Candle Range Theory Pattern. So let's get into it. Benefits of trading this model. It's a 3 candle pattern on the 4-hour chart. It sets a trading window between 5 a.m. and 9 a.m. Obviously, if you see those setups, there are no trades. It's a simple pattern, very easy to see, very hard to miss. Has a built-in stop loss and built-in take profit goals. Okay, and this is also for people who trade the London session. These times of 9 p.m., 1 a.m., and 5 a.m. are Eastern Standard Time USA. Okay, so whatever that converts to in your region of the world, you're gonna have to do that on use Google or the internet. So the basic pattern, you're going to see 3 candles that look somewhat similar to this. This is the basic one, but there are a couple of variations. The 9 p.m. range, which is most of Asia's session, sets the initial trading range of a high and a low. The 1 a.m. 4-hour candle will be a consolidation zone where you shouldn't see much movement in this range at all. Sometimes it may poke above the high of the 1 a.m. Of the 9 a.m. range and then close back inside of it, or it may have a slight breakout of it, maybe not by more than like 5 or so pips. And then our trading window of 5 a.m. is where trading starts. If you're going short, you're looking for the open, high, low, close model on the 4-hour candle. If you're going long, you're looking for the open, low, high, close. So we're going to break that down now. We're going to break this down candle by candle so you know what to expect at each time of the day. So for the 9 p.m. candle, or you could say Asia, all right, you should see one of two things. You should see either a large range candle, okay, or a smaller range candle, either one of those, okay. So it does set the trading range, okay, top and bottom. Tight consolidation ranges can set up a big move, like if they're less than half the average true range. For example, if the average true range is 50 pips for a pair and the candle's only 15 pips, a big move can come later. And it's good if it closes near the high or low of the range. So if this was a red candle, if it closed down here, that would be great. If this was a green candle, if it closed up here, that would be great. I left it gray because it can go either way. Doesn't matter. Okay, so all trading should take place inside this candle's range, inside this candle's high or inside this candle's low. You should be going long around the low of this candle or this candle here. They're both 9 p.m. ranges. If you go short, you should be going short around the top of this range or around the top of this range. Okay, so but that's what you should see for 9 p.m. The 1 a.m. candle. These are tight consolidation ranges, is what you should see. The tighter, the better. The smaller, the better these candles are for 1 a.m. Sometimes they may make a new higher lower of the day. Sometimes they may not, but that part doesn't really matter. Generally, though, the higher low of this candle should hold to be valid. Now, there are times where the 5 a.m. candle may poke below it, but then when it starts to close inside of it, you may be good to take the trade in the opposite direction, but I'll show you more about that in the next slide. Now, the 5 a.m. candle, that is our main focus because that is when we start trading. That's when London has already started. Everything is underway, and we're going to see how things progress. So this is the main focus. So now when we talk about open, high, low, close, or open, low, high, close, in the distribution candle, also known as 9 a.m., 5 a.m. to 9 a.m., this is what we talk about. These are the types of candles that you should see between 5 and 9. This is how the 4-hour candle should look ideally when it closes. So if you're going long, you want to be long below the open price, somewhere in there, okay? Or catching the wick and then adding to your positions as price expands to the upside. And then you have a high and a close. When going short, you want to be short above the open price, the 5 a.m. open price, somewhere in the wick. And then as price expands downward, ideally you're adding your position somewhere around the open price, and then you're just enjoying your straight drop to profit. Because when it comes to these ranges, you're looking for a straight drop or a straight rise with very little retracement. These ranges typically don't have big wicks. Okay, we like them to be fairly small, or they may just go straight up. So you'll see both of those. If you see something different, something may be wrong, you may want to get out. So what should you see when you come to the charts? Okay, you're going to see one of these two things. Now, I did all short examples, but if it's a long, just reverse it. Just flip the chart upside down. It's the same principle. So you should see the 9 p.m. range do something like this, and then the 1 a.m. range do something like this. 1, 2. Okay, so when you come to the chart, say around 4:45 a.m. Eastern Standard Time, this is what you should see forming. Here you may see two small ranges at 9 p.m. and 1 a.m. Maybe you'll see two small ranges like that. Or you may see where the 5 a.m. range, where the 1 a.m. range has not touched the high or the low of the 9 p.m. range. You may see this where this high is still intact. It has not been touched. So what do you expect price to do based on these three patterns? Something like this. In the traditional candle range theory pattern, you want to see price not even touch the high again of the candle range. It just does pretty much does a slight retrace and then a straight drop to the bottom. If you have a small range, you expect the price to break out of the range because these two candles were small, and so price has been consolidating in order to give a large expansion either to the downside or upside of its long. And if you have that inside bar where the high wasn't touched, one of two things could happen. Either between 5 and 9, price may go up and then touch the high of 9 p.m. and then drop, or sometimes you may see just a straight drop. This one's a little harder to gauge, the blue path here, because there's no way I can tell you, yeah, price is just going to go straight down. You'll just see it happen. So if you want to try that, you can. It's very rare that I try to trade something like this, though. I like seeing something like this more. This is easier to see where price goes above the high and then closes back inside of it. That's easier than knowing, okay, price is going to drop and then just continue to straight drop. Okay, so that's my preference, but you will see either one of these sometimes. Okay, where basically the high of the 9 p.m. candle holds, or if you're long, you'll see it where the low of the low of the 9 p.m. candle holds. Okay, if I misspoke, let me try that one more time. You'll see sometimes where the high of the 9 p.m. candle will hold or the low will hold, and then starting at 5, price will just do a straight rise or a straight drop. Okay, that's what I mean. Okay, so where should you be trading? There is the golden zone. The golden zone should take place in a small, slim area, okay, where it's going to be, if you're going short, above the 5 a.m. open price or below the high of the 9 p.m. candle. So this is this zone right here. So if you come to the chart, you see 9 p.m. here, 1 a.m. here, and then when price opens at 5, if it does a little retrace, it opens at 5 and goes up, but it's still below the range, you're clear to trade. Stop loss can go above the range of 9 p.m., or you can do it above the 1 a.m. candle as well. Okay, I'm having trouble switching between a.m. and p.m., so forgive me if I misspeak. But it's always going to be 9 and 1, okay? And then obviously, if you're long, just reverse it. You're going to want to trade below the 5 a.m. open and then above the low of the 9 p.m. candle. Same thing, just like I said, flip the chart upside down. That'll give you your golden zone for going long. Now, there is an optional indicator that you can use, which is the open price by session open price by Intrusive FX for showing you the by showing you the 5. That should be the 5 a.m. open price. Sorry about that. I mistyped that. But I'll show you how to set it up. So we're putting it all together. This is what you're looking for. Okay, same basic pattern, just at different times. Okay, so you have the 9 p.m. candle here. Okay, the 1 a.m. candle here, which does not show a lot of movement. When I come to the charts, these are the main candles I'm looking for. I'm looking for a doji right here in this time frame, and then I'm expecting a big move up. There are times where price will break out of the range, but don't expect it. There to just know that it's possible. Okay, so there's that. And then as far as the entry goes, remember I talked about the golden zone. This black line right here is the 5 a.m. open. Price goes below it for a little bit. You basically got a double bottom right here, and then you're safe to enter anywhere around here. You can set a stop loss below this low. This was good for about 1 to 5 with a 15 pip stop loss and a 75 pip take profit. Price exploded out of the range and just did what you like to see it do. That's all you're looking for. Remember, we're talking about straight rises or straight drops when we're trying to chart. I don't know what's going on with my mouth today, but when we're trading the candle range theory, okay, you're looking for a straight rise or a straight drop. So this is example of the small ranges. Remember I talked about where if you see two small ranges with 9 p.m. and 1 a.m., it can lead to a large 5 a.m. candle. Here is an example of that. So you have two small ranges right here, okay? And then when 5 a.m. rolls around, okay, this black line right here is the 5 a.m. open. Price really didn't get to go up there. However, it's not labeled on here, but there was a little bit of a fair value gap right here. But as price consolidated, if you were expecting price to break out of the range because of the fact that this is a tight range, you would have been safe to enter anywhere between about 5:50 and 7:30 a.m. And this would have been, if you would have did a 5 pip stop loss and a 25 pip take profit, this would have been good for 1 to 5. So you have that. Again, another example of small ranges leading to a big expansion candle. This is one where you had a straight rise where it just went straight up. Okay, so on the 5-minute chart here, all these smaller charts are 5 minutes. Okay, here was the 5 a.m. open. Price barely went below it and then just bang, exploded outside of the range. Done deal. Okay, so that would have been good for 1 to 5 if you did a 5 pip stop loss. Very tight ranges can give very tight stop losses. So, definitely pay attention when you come to the chart and see two back-to-back small ranges. It's not guaranteed that price will break out because sometimes you may get another small range, but other times you'll see price explode. So just be ready and know what to do when you see it. So the candle range theory is a framework, but do not look for perfection. Okay. Always give grace. So there can be more confirmation when it comes to the 5 a.m. trading candle, and that is fair value gaps in the 5-minute chart. What do I mean by that? Here's another example. We have a small 9 p.m. candle and a small 1 a.m. candle. So now let's see where some fair value gaps are on the 5-minute chart. If you don't know what a fair value gap is, a fair value gap is just a spike in price. It's a 3 candle pattern whereby prices move so fast that it leaves a gap where price has not even retraced into it. It's just a straight move with no movement to the downside. Okay. So when you see fair value gaps that hold, that's a good sign that momentum is that's present in the trade. Okay. So you see right here, we have 1, 2, 3. Okay. This pattern right here, 1, 2, 3. This gap right here shows that this candle went straight up and did not really give a chance for sellers to even take advantage of a pullback. Okay. So when you see this and it holds, that can be a good sign. And then so you can, just use this as a confirmation indicator to say, hey, I think I'm in the right segment of the market. All right. So there's one there, another one here, here. And sometimes it'll retrace into the gap and then boom, it explodes right back into it and out of it. Now, do you have to be like a fair value gap master and study fair value gaps 24/7 to be proficient in them? No, you do not. This is just something to confirm that you're on the right side of the market. That's all. If you see fair value gaps develop in the way of your bias, that's all that means, is that it's a good sign. Here's another one with a classic breakout of the 915. So you have the 9 a.m., 9 p.m., 1 a.m., and then the expansion to the downside. And we see these fair value gaps being mentioned or being noticed right here. So you have one here, and it just price keeps moving to the downside, and that's it. And they hold. So every time price retraces back into the gap, it just shoots down again. That's what you love to see if you're short. All right. So this would have been good for an entry around 5:25 a.m. with a 1 to 5 risk to reward with a 10 pip stop loss and a 50 pip take profit. So fair value gaps just show you that there's momentum. If you want to use fair value gaps to scale into the trade as well, that can be an option. For example, if you get in here, that's fine. And then its price breaks out and you see these gaps, you could have scaled in right here on this green candle, maybe a couple more entries. And then after this fair value gaps develops, maybe a couple more before price does eventually hit bottom and start to retrace. Okay. So don't get greedy with it. But at the same time, if you want to use fair value gaps as a level to add to your position, definitely do that. You will not regret it. So one last tip as well, make sure your stop loss is the entry price of your base entry. What does that mean? Your base entry is your first position. So if this is your base entry and you start to add to your position, either set this one to break even and then your subsequent entries can just be whatever this price is right here. So if I add a trade here, my stop loss is here. And then if I add more here, then my stop loss will be back here. And that way you can help manage risk. But if you're going to scale into positions, because I scale into them all the time, but don't trade this without a stop loss, okay? It's imperative that you have a stop loss so that way you can control your risk. So let's see here. So here's backtesting made easy, made very, very easy. So let's show you now how you can spot this pattern at a moment's notice. When I'm going to show you how to set up the chart, it's going to show you the 5 a.m. opening price, and it's going to do so by a black line. When you see the black line on the chart, all I look for are the expansive candles, the open high low close or the open low high close models that I went over. And let me just show you what that is, just so you have an idea. I'm looking for these, okay, at 5 a.m. Okay, so this is the type of candle that I'm looking for, something like this at 5 a.m. or something like this at 5 a.m. So now let me go back to the chart. Okay, there we go. So right here, here's one. This black line means this is 5 a.m. open price and it's expansion to the upside. Then I just check the 2 candles that preceded it. 1 a.m., 9 p.m. See how you got the range, price pokes below it. This is a doji, and then it expands to the upside. That's it. Very simple. And then if it fits the model, then I'll drop down to a 5-minute chart just for analysis and possibly to take some screenshots. Okay. Here's a short example. The black line designates the 5 a.m. open price. I check the 2 candles, 1, 2. I have my 9 a.m. range, which is small. I have a 9 p.m. range, which is small. a 1 a.m. range, which is also small, and a large move to the downside. Okay, it's the same thing over and over where we got the range breakout. So this is a valid 915 pattern. Again, drop down to the 5-minute, take some screenshots, do whatever I got to do. So let's get to the fun part now and set up a chart so I can show you how to get this same template. We'll go to Trading View, and let's go to a. Sorry, I got a live trade right now. A rare moment you get to see a real trade. I'm in Swiss yen short, but anyway. Let's go to. Just going to do something at random. So EuroCAD 4-hour chart. Okay, so let me get rid of all the indicators. Okay, so what I'll do, or what you should do, you're going to go to your indicators. You're going to find a indicator called Session Open Price by Intrusive FX. You will click it. It won't show up initially, so go down to the 5-minute, and then you'll see these lines appear. Okay, you'll go to the arrow. You'll go to the gear. It doesn't matter. I know this says New York Open, but that part doesn't matter. Now, I put it on 5, and then I change this to like 5:15. I make this color black. And then what I do with the others is I just white them out. I change the color to white. I put the opacity down to 0 so they just don't even appear because I don't need them. And I get rid of the labels. So that's label, opacity 0. The only time I'm concerned about is 5 a.m. Zero that out. No label. So now when I go back to the 4-hour chart, I should see the lines appear. If I don't, maybe I'll need to do it again. Okay, there they are. I left them dotted. I'm sorry. I meant to have it solid. So give me a second here. I changed it to solid. So they're just a little easier to see. There we go. So now I go to, let me just fix this. Okay. And then I just put my cursor over the candle to be sure it's at 5 a.m., which it is. Okay, 5 a.m. right there. Bang. Okay, 5 a.m. That's a solid line, but that's 5 a.m. and then one more 5 a.m. Great. So now what I do, just if I'm back testing, I look for the expansive candles, the open, high, low, close candles. So let's see if we can spot. I'll do one long and one short. Okay, so I see an expansive candle right here. This is, I would consider this one, but I'll just explain the nuance. Give me a second. Okay, so see here how this is an expansive candle. So then I check here, I see a doji, and then I see the 9 p.m. range. Now, even though it closed outside, I'm going to take a look and see how much did it go down by. Let me see, give me 1 second here. And let me just turn down my notification volume in case I get more. There we go. So this candle broke outside this candle's low by about 5 pips. That's forgivable to me. So what I would do is I would still mark this, and then, but remember the trading range is still at the candle's low. So real quick, just for the sake of the video, if I drop down to the 5-minute, my entry would be, like right in here. This is at what, like 5:45. Okay, that's the entry right there. Okay, inside the range. If you want to add fair value gaps as well, the fair value gap, I use this one, fair value gap by Nephew Sam. The one thing I would recommend on that one setting is that you want it to be sure to say wait for candle close to identify the fair value gaps, and be sure you have that highlighted too. But here's one right here, so that's a good sign. We don't get another one until like later on. This probably was one right here, but it got filled in. But I just look for those gaps to be sure, okay, is there any momentum showing? And I mean, you see one here, so you see it's already going. But like I said, for the sake of tight stop losses, you want to try to get in near the range's low. So if you could have got in right here, it's at 5:45. If I do it, I always try to do a 10 pip stop loss. It doesn't always work out like that, but this would again be good for a 10 pip stop loss. I don't know if that's let me see, 30. Then I go back to the 4-hour. Did it keep going up? Let me see. Yeah, it did. All right, so that would have been good. So there you go. I mean, it's just that simple. Let's do one more. Let me do a short example on a different pair. Get rid of those drawings. Let's see if we can find a short trade. Let's try Aussie CAD. Just doing it randomly. I'm not, Okay, so we have our indicator. Be sure to save the indicator template as well. Yeah, and here's one right here. So remember, I'm just looking for the black lines in the expansive candles. So this right here was at 5 a.m. We have our range high at 9 p.m. So that's the high. There's the low. Okay, right there. And then you have a 5 a.m. open. It went up a little bit and then down. So if I'm looking for a good entry on this, it would be about, and we'll throw the fair value gaps up there. Why not? Okay, so about 6. It closed inside right here. If you can get a fair value gap near the range high, that's ideal too. So you could have got, I know it kept dropping, but this is good for a 1 to 3. It did hit 30 pips, so it could have scaled in. And again, when we talk about the scale in part of it, using fair value gaps as a scale in mechanism, your first entry could have been like right here. And then there was another fair value gap that you could have got in right here. And even on this retrace again, just add a couple. I add sometimes 1 or 2 at a time. That's just me though. You trade the way you see fit. And then that probably would have been it. But there you go. So that's how you back test. Real easy. You just look for those expansion candles, check the prior 2 candles to it, and then you're in business if you find one. But again, not every expansion candle qualifies because, let me go back. Because sometimes you'll see an expansion candle, but the prior 2 candles don't show the pattern. Like for instance, okay, here's one right here. This is an expansion candle, but I checked the 1, 2 candles before it. 1, 2. This is not the candle range theory. These are just 3 random candles, and price just kept dropping. That's not what I'm looking for, though. Okay, I'm really just looking for a swing high, higher high, lower high. Okay, and this right here, the last candle in that sequence is the 5 a.m. candle. That's all. And then same for longs, low, lower low, higher low, and the last higher low is the expansion candle that you're looking to trade. That's it. But just because you see an expansion candle doesn't mean you have a valid candle range theory. Okay, so everything has to flow together. So yeah, and that's it. All right, so let's finish this up. So in conclusion, simple repeatable patterns can keep you paid. Not all the ranges will be perfect. Sometimes the higher low of the 9 p.m. range won't get swept until 5 a.m. And that's that inside bar pattern that I showed you. So just be aware of that as well. Only trade when price closes back inside the higher low of the 9 p.m. range. Okay, that's still your trading range. If both the 9 p.m. and 9 a.m. if both the 9 p.m. and 1 a.m. ranges are small, look for that 5 a.m. candle to be big. These times are kicking my behind. But just look for the third candle to be big if the first 2 are small. Okay, risk management is still rule number 1. Keep the losses small. With this pattern, though, you can get big wins. So let the losers lose. They're inevitable. But when you're right, at least with me, I like to be right big. Okay, so if you don't think you can get 1 to 3 or more, 1 to 2, 1 to 3, don't take the trade. Sometimes if a range is small and you don't think it's going to really pay out, just don't take it. It's okay to have a standard. 1 to 5 is usually my max risk to reward. So don't be greedy. Price can come back. Okay, the 9 a.m. That shouldn't be 9 a.m. That should be 5 a.m. Okay, but the 5 a.m. range can't end in a doji. And what do I mean by that? I want to show you this because this is very important. Let's see. Let me find one. I promise it won't take long. Give me a second. Really, any doji will do. But it doesn't matter. Let me see if I can find one here. Here we go. Yeah, like this. Okay, this isn't at 5 a.m., but I just want to use this as an illustration. This right here. Sometimes you'll have this, whereby I'm talking about this candle right here. Let me put an arrow below it so you can see it. This candle right here. Okay. Let's say you were just buying on this candle. It opened right here. This candle went up 37 pips, but then look what happened. It closed down. Okay. If you're up 40 pips, don't let that turn into a loser. Okay. Because this can happen at 5 a.m. The range theory could play out, but it'll hit like the top of the range or do a decent it'll hit a decent amount of like 30, 40, 50 pips. But then don't think it can't spend the last 2 hours retracing the whole time and end red or end green, the opposite of your bias. Okay, that can happen. So just be aware of that. All right, that's what I mean when I say it can end in a doji. So if you can keep your losses small and get one big winner a day, you'll be fine. You always want to live to survive and trade another day or take another trade. Okay, if one loses, like even today, I've had I think about 4 losses, but right now I'm in profit. And on that Swiss yen pair I just showed you when I started opening up the live charts. But this was a losing day at first, but I don't let them bother me because they're always small. I try to keep them as small as possible because I know that when I get my winner, I'm going to get everything back and then some, God willing. So that's it. That's the deep study. This is the last one I'll do unless something drastic happens, but I don't see that happening. These are really it. So if you have any questions or anything, definitely leave them in the comments. But that's the whole system. From this point on, it's just a matter of risk management and being smart with your trades, letting those losers lose and adding to those winners. So I appreciate your time and attention. Thank you for the subscriptions, the comments, and the likes. I appreciate all of them. You guys keep trading. Have a great day and take care.